Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. The blistering run in U.S. equities kind of hit a wall on Thursday. We had a spike in wholesale inflation, and it kind of caused markets to reduce bets on a Fed rate cut next month. Money markets now see about an 85% chance of a 25 basis point rate cut in September. That's after fully pricing in a rate cut on Wednesday. And any notion of an outsized cut, let's say 50 basis points, I think it's fair to say that's been snuffed. And as we get set to wrap up the week, we'll look at consumers in the Asia Pacific in a moment. I'll be joined by Matthew Driver. He is Executive Vice President of Services for the APAC at MasterCard. But we begin here in the States. And as I mentioned, U.S. producer prices jumped in July by the most in 3 years, fueled by higher import cost as a result of those tariffs. PPI month on month up 0.9%. The annual rate, 3.3%, and services cost increased last month by 1.1%. If you're wondering, that's the most we have seen since March 2022. Joining me now is Mark Luschini. He is the Chief Investment Strategist at Janney Montgomery Scott. Mark is on the line from Pittsburgh. It's good of you to make time to chat with me. Let's talk about this PPI print. What does it say about the impact of tariffs on the economy?
Well, that we're learning more as we get these data releases that are beginning to show some signs of how tariffs are manifesting in items that may ultimately feed into the economy, either in the form of higher prices yet to come, whether you call that a tax or inflation, and or the other side of it, perhaps even the darker side of it, is to what degree it is going to erode consumer spending in a way that could have a deleterious effect on economic activity.
What about the extent to which it's going to begin to compress margins? I'm sure for a person such as yourself, that's got to be a concern.
Most definitely. And we've heard a lot from companies here as we're deep into the second quarter earnings season about what companies have done or attempted to strive to accomplish over the last couple of months in terms of tariff mitigation measures. And so for the most part, it hasn't really shown up necessarily in the results, which so far in the second quarter have been quite strong. But at the same time, though, we know that some companies have stated that they are going to be passing along costs, and to some degree, they have absorbed the cost. Now, the proportion of which is going to be either eaten by exporters and that which is going to be eaten by importers and or passed along to consumers is still evolving, but it would seem as though there's going to be some margin pressure applied from these tariffs that isn't going to be able to be fully passed along to consumers, and therefore could have an impact on earnings as we go forward. And given the rich valuations we have today in the stock market, highly dependent upon not only positive economic activity, but the earnings growth that would be a byproduct of that, it's going to be very important to monitor as we go deeper here into not only the third quarter, but ultimately hear from management in third quarter earnings season.
So today, a number of economists were saying the report is essentially a validation of the Fed's wait-and-see approach. And the head of the Fed Bank in St. Louis, Alberto Musalem, was telling CNBC it's simply too early for him to decide on whether to lower rates at next month's Fed meeting. Where are you in understanding what the Fed may do, let's say, between now and the end of the year?
Well, certainly they're going to continue to be data dependent. They've said as much. And so that leaves, certainly before their FOMC meeting in mid-September, at least another CPI print to come, another jobs report to come. And so that and other, obviously, data in between. But importantly, those two will give further evidence as to what degree we continue to see mounting price pressures coming from tariffs and or obviously its impact on the job market, which is in a somewhat delicate position as we speak, particularly given the last print we had on jobs, which some have suggested had the Fed had that prior to their decision, they may have already cut interest rates as a consequence. So obviously, I think those two factors are going to matter more than all the other data that, while be interesting to note, will ultimately be the driver of the Fed's decision as to whether they prioritize maintaining the job market if it looks like it's stalling out, or conversely, combat inflation if, in fact, these price pressures appear to be more than transitory that could ultimately lead to some unmooring of consumer expectations with regard to forward-looking inflation prospects.
I'm going to change gears. Today we learned that the Trump administration is considering taking a stake in Intel. This potential stake on the part of the government could support expansion, we are told, of Intel's domestic manufacturing. What is your sense of the industrial policy that the Trump administration has been rolling out? Do you think it's going to be effective in certain areas? I know you're in Pittsburgh. We just had a deal between Nippon Steel and U.S. Steel. The Trump administration was obviously involved in that. And I'm wondering, from your perspective, whether you feel as though what the Trump administration is putting forward in industrial policy will have a material effect.
Well, I think it can have some positive benefits. I mean, it's too soon to tell what's going to happen between the deal that was basically arranged by President Trump with regards to Nippon Steel and U.S. Steel, mostly to maintain substantially all the operations in Pittsburgh as well as employment. But at the same time, it is not necessarily unprecedented, but rather uncommon to see this kind of industrial policy being applied. We also saw it, obviously, with MP materials relative to rare earth metals. And so this is kind of a continuation of the same thing where there's these strategic industries that President Trump and his administration have touted are paramount to the success of the U.S. And its competitive state relative to other countries around the world, and is trying to make specific surgical investments in industries and or in companies, in the case of Intel, which has had some trouble from a financial standpoint to perhaps meet the obligation that it has committed to underwrite the facility in Ohio to produce semiconductors and the kind of technological products that are necessary to, once again, keep the U.S. on the forefront of technology, but as well remain competitive at a minimum on a global basis. So, too soon to tell what may come of it, but ultimately, you would hope it would be a win-win, but it also invites a bit of a moral hazard, which is to say, to what degree does this breed an industrial policy that starts to actually impact the capitalistic, narrative that the U.S. has embraced for so many decades, if not centuries, relative to, the interests of the companies and its shareholders, and obviously its ability to compete on a not only domestic but world stage without heavy-handed governmental influence. So it's obviously a policy that everybody's watching closely. In the meantime, this is just the latest example of something that's already been put forth in terms of MP materials and the steel company's arrangements.
So the equity market kind of stalled today. Nonetheless, the S&P was able to extend a record high. NASDAQ comp very near to a record. Mark, are you still finding value in the equity market? I mean, we could argue that, especially in the area of technology, some of these valuations are pretty lofty.
Well, it's more of a function of seeking relative value, Doug. If you look at the S&P 500 in the aggregate as a capitalization weighted index, it's trading at, call it roundly, 22 times forward earnings estimates, which is on the richer side of where it's traded at over, say, the last 5 years, which is closer to 20, or over the last 10, which is closer to 18 to 19. But you could say, well, given the concentration in tech and tech adjacent companies, that's having a big influence because their price to earnings multiple is pulling up the multiple of the overall market. Again, the multiple for the Magnificent Seven, for instance, is approaching 30 times those same 12-month forward earnings estimates. So what does that leave? That leaves the S&P 493. And you might say, well, they should be cheap or at least offering good value. And there, the answer is, relatively speaking, yes, trading at about 19 times forward earnings as a group. But at the same time, even then, hardly inexpensive relative to, a typical market environment, which you would expect, 16 or 17 times forward earnings for non-tech related companies. So, I still think there's opportunity, particularly in the context of a market that I still think is poised to continue to move higher on the back of an economy that is perhaps experiencing a bit of a soft patch, but I think has some reason to believe is going to pick up a bit of a tailwind tailwind as we get into the fourth quarter of this year and into 2026, particularly with some of the provisions from the One Big Beautiful Bill Act. And in addition to that, I think we've seen that companies have done a pretty good job so far in being able to handle the impact of tariffs by way of all kinds of measures that they've taken to reorder supply chains, seek operational efficiencies, and to some degree likely pass along some price hikes, but hopefully not so much in a way that the consumer rolls over. But collectively, it leads me to believe that this market is still very investable and buyable because I expect higher prices yet before the year is out.
All right, we'll leave it there. Mark, thank you so very much. Mark Luschini there. He is the Chief Investment Strategist at Janney Montgomery Scott, joining from Pittsburgh here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. This morning in Asia, markets are focused on the readings for Chinese retail sales and industrial production. I think it's fair to say that recent measures by Beijing to strengthen consumption reflect a growing recognition of domestic demand's pivotal role. Let's take a closer look now at the consumer across the Asia Pacific. Joining me now is Matthew Driver. He is the Executive Vice President for Services in the APAC at MasterCard. Matthew is on the line from Sydney. Matthew, thank you so much for making time to chat with me. I know consumers across the Asia Pacific are as varied as the economies themselves. Japan, for example, is dealing with levels of inflation it hasn't seen in decades. Other countries, as we know, are dealing with very, very different dynamics. But I'm hoping you can speak to the overall level of consumer spending that you're seeing across the APAC. What is it right now?
Yeah, sure. Look, I think, and thanks for hosting and having me on the show. Look, despite the macroeconomic uncertainty, consumer spending across APAC remains healthy. I think that's driven by a couple of factors that are important. You've really got low unemployment. You've had a decent amount of real wage growth, and that's really helped, right, to essentially ensure that you've got demand across segments. I think our Economics Institute forecasts steady GDP growth. So what we are seeing is broad-based. The customer is pretty resilient. There's been a little bit of stress in some places as rates have been higher for longer, but you have to think about there are also some longer-term drivers that are going to be quite positive, right? You've seen interest rates are starting to come down, number one. Number two is you've got some easing of fuel prices. That's point number two. And point number three is, goods continue to be cheap. China's leaning into the region, and so that's helping, on the value side as well.
Do you have a sense of whether U.S. tariff policy has adversely impacted consumer sentiment in the region?
Look, I think that, we're really trying to think through, the impact of, tariffs. I think, look, it's a complicated environment, but look, Asia Pacific continues to navigate that. There are going to be some alterations and adjustments, but also I think while those dynamics pose some challenges, they also underscore that the region is very resilient and adaptable, right? I think that post-COVID, some of the supply chains have become pretty flexible. That's been very, very important. And while tariffs have raised import costs to a certain degree in more price-sensitive markets, there's been, trying to, adjust, consumer spending. There's been a little bit of value shifting like we talked about. But what we're really trying to do is make sure that, we're helping our customers navigate that with insights and intelligence. So I think that despite some of that uncertainty, people are probably putting off some of the longer term transactions, right? They're really focusing on, how do they ensure that they're driving value today, shifting those patterns of spend a little bit. And so with that in mind and the factors I mentioned earlier, we are seeing pretty steady demand. And that's really reflecting the resilience of the consumer overall.
So I'm wondering about the challenges that MasterCard may be facing right now, especially among the younger generations who may prefer digital apps rather than the use of a credit card. I mean, are you seeing the impact of that? Is that presented something that you've had to address pretty specifically?
Well, I think what you've got to realize is that a lot of the digital applications, MasterCard deeply participates in these already, right? So whether it's if you think about the digital wallets out there, they're enabling a digital transaction. That digital transaction is secured, and the commerce happens on the MasterCard network, as it might do with Apple and things like that. We also work on embedding our partnerships with these digital wallet providers. So we've just announced a partnership with the Alibaba group about their wallets enabled to utilize our contactless technology when those consumers travel overseas. So I think it's much more about saying that innovation and that mobile first centricity that happens in AP is actually really important for us, because it enables us to find opportunities to collaborate. And the trust and security that comes with the MasterCard brand is a very, very important aspect of that. So we're, if you like, powering and extending the reach of these wallet players, and we're also providing that trust and reassurance. So we're definitely leaning into that, and we've grown our business substantially because of our ability to partner with these digital players.
We talk a lot these days about the revolution in artificial intelligence, whether you're talking about a large language model or the build out of data centers, and I'm curious about how MasterCard is embracing and using AI.
Yeah, well, I mean, look, that's a great question, and you wouldn't be too surprised to know that we've been doing AI already for a long time, right? The original kind of machine learning kind of approaches that we have been using to really power our network and protect consumers on the fraud side. We've been doing that 15, 16 years already. I think what's happening now is in a region defined by speed, complexity, and digital acceleration, we're really using data and AI to help transform the business. So to really help commerce be smarter, safer, and more personal. So that means that we already are building on using this in fraud and scam protection, but we're also working on advanced analytics and personalization, and everything we do that really helps provide the personalization that consumers want today, but also help our bank partners, merchants, etc., navigate the complexity by bringing insights into action and really navigate a dynamic environment with confidence. So we sort of really talk about coming back to this point about leveraging AI to make commerce safer, smarter, and more personal. And that's a good way of thinking about it because it's such a complex topic.
So as we are speaking, I'm looking at the price of Bitcoin, which is trading very near record highs, and I'm wondering about the challenge that digital assets present to your company, especially given the fact that the blockchain technology is pretty revolutionary. I don't know whether MasterCard has a similar type platform that enables it to maybe compete more directly with digital assets. Could you share some perspective on what MasterCard is feeling right now as we see kind of this explosion, this continued explosion in digital assets?
Yeah, look, I think that the one thing that's really important is to realize that MasterCard already has a significant number of patents in distributed ledger technology, right? So we've been doing this for a long time. So that's point number one. Point number two, we're really been working carefully to ensure that we're partnering with crypto players, but crypto players that really have the right degree of customer transparency, protections, and making sure that they've got the right KYC and onboarding capabilities, really with the ability to on-ramp and off-ramp transactions to ensure that if people have these assets, that they can actually leverage the MasterCard network to release value and actually transact. So I think that's the second thing. So we're partnering with the exchanges, with the right ones that have the right standards for us and making sure that you've got that trust and security layer. And then the third area we're really working is on the multi-token network, what we call MasterCard or MTN, which is really ensuring that we'll have the ability to support and settlement into stablecoins and things like that. So I think that we're really already directly participating in this space and ensuring that consumers have the utility that obviously some of these digital assets don't have. And they can leverage the trust and security of the MasterCard network to create that utility, but also carefully partnering to make sure that we're actually upgrading our network to support the ability to settle directly in stable coins atomically, which also just raises the performance of our network. So we're quite extensively partnering and enabling our systems to ensure that we're definitely leading and ahead in this global transformation.
Matthew, we'll leave it there. Thank you so much for visiting with us. Matthew Driver there. He is the Executive Vice President for Services for the APAC at MasterCard, joining from Sydney here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.